In this week's episode of the Stockscores Market Minutes, I'm going to talk about the benefits of a stock market crash. Yes, there are good things about the kind of weakness that we are seeing in the market now. Of course, I'll do my regular weekly market analysis. We'll figure out where stocks, commodities, currencies are likely to go in the near term, and I'll look at the day trade of the week on FRGE. All right, so lots of weakness in the market continuing again today as interest rates rise, as the markets are falling. There is something good about all of this, however. Stock market crashes are good for investors. And let me explain why. First thing is that lower prices create value. Would you rather buy a stock at $100 or at $70? And so if you're looking for opportunities to buy good value, then stock market crashes create that. Of course, the people that tend to be the bargain hunters, those willing to buy when the markets are going down, are institutions because they're more value oriented. And so when prices fall, the institutions come in and they tend to be longer term holders of stocks, which means less supply of that stock in the future. So lower prices leads to value. It also leads to better people holding the stock. Now, there's also this idea that weakness will shake out the weak holders of stocks. You know, those short-term traders who are really just trading, people like me really, that are in and out very quickly. Well, when there's a little bit of weakness, stops get taken out, and those weak holders are going to sell, and that reduces future selling pressure. And that's why markets tend to do very well after corrections, after crashes. And that's the biggest thing to think about is when markets sell off, we often get big rallies following. And I'll show you a chart on that in a moment. You see, really, these lower prices motivate buyers to act. They are an incentive for people to come into the market. The worst stock market crashes come after hot and irrational markets. So we had a pretty hot and irrational market leading into 2021, halfway through. And then now we've had a substantial correction. Well, that's going to lead to the next bull market because value comes in, there's fewer sellers, the people that own the stock are long-term holders. Let's take a look at the chart of the Nasdaq. This is a weekly chart going back 5 years. And what you can see is whenever there's been weakness, you get good rallies. Weakness, good rally. Even short little 3 or 4 week pullbacks lead to good rallies. And so we see that over and over again. The key is to wait for the downward trend line to be broken. And that's what we're watching. That's what I do every week in this video is try to figure out when is the turning point. And if you're subscribed to the channel, if you click on your notifications, you're going to get those uploads that I do every week. It's always free, so why not subscribe? All right, well, let's get into this week's regular market analysis. I'm going to jump over to the Stockscores website. We're going to take a look first at the S&P 500 ETF, SPY. And you can see that we came up to the downward trend line. We could not break it. And so we have pulled back in the last couple of weeks. The thing to watch for now is, do we pull back but not go to new lows? Do we build a rising bottom? And if we do build a rising bottom, then we are better set up for a break of that downward trend line. If instead we move down through that floor from the lows of, I guess that was June, then you want to be cautious because more weakness will follow. In the short term, we can look at the 1 month 60-minute chart, and you can see there that we are in a downward trend, and as long as we're in that downward trend, we should remain fairly cautious. Had some weakness this week again, and for this to turn around, for us to really want to take an interest in buying again, we need to start breaking these downward trend lines from rising bottoms. All right, let's jump over to the Canadian market, T.XIU, and the TSX also suffering this week. This is the daily chart. You can see this little upward trend line was broken about a week and a half ago, and since that time, we've moved lower. It's so simple. Just draw a line across the bottoms. When that line is broken, weakness follows. When you draw a line across the tops, when that line is broken, preferably from a rising bottom, you usually get strength. We don't have that yet. that's what we want to watch for. Looking at the short-term chart of the TSX, you can see that we broke this very steep downward trend line on Friday, but we're still below this one, and so we might go a little bit sideways here. The market was a bit oversold, but I'd still be fairly cautious with Canadian stocks. Let's take a look at some of the commodities. Actually, let's take a look at the US small caps first. IWM. I like to look at this because it's a good proxy for what retail traders are doing. This is small cap stocks, the things that people that trade from home like to do, and you can see that it too is in a downward trend in the short term. However, we are quite oversold and due for a little bit of a bounce back, but until we can break that downward trend line from a rising bottom, you should be pretty cautious. All right, let's get into commodities now. We'll start us off with the USO, which represents oil, and here you have a descending triangle on the daily. If we break down through support at 70, that implies lower prices. However, we should look at other time frames as well, because on the 3-year chart, you can see that that long-term 3-year upward trend line is still intact. We could come down to that $62 level on this, bounce off of it, and still maintain the long-term upward trend. So it really depends upon your time frame. If you've got a long-term view, if you've got long-term holdings in energy and you bought them, back when this trend started back in 2020, it still remains a hold. If you're a short-term trader, this is a sector to avoid, because as we see with the short-term chart, there's lots of froth, no trend. We have some weakness. If we break down again through that, call it 70.5 on USO, then we could be heading lower down to that longer-term support of the upward trend line. GLD representing gold. And you can see, let's take a look at that 3-year weekly chart. You can see we're testing support. We dipped below it this week, managed to bounce back, but we shouldn't ignore the fact that there's falling tops. That means the sellers are in control. The buyers are winning, the sellers are winning. The buyers win, sellers win. Buyers win, sellers win, buyers win, sellers win. Notice that every time the buyers win, they can't push the market as high as they had the previous time. So if you think about who's winning the battle between buyers and sellers, the sellers keep forcing the buyers back, and that's what causes falling tops. That's sort of a good analogy for why falling tops are a sign of pessimism. Let's take a look at the short-term chart on gold, and there you can see still in a downward trend. Yes, we bounced back a little bit Friday, but we're really just bouncing back from being oversold. Much like we were here, we come up, we'll probably come up to the trend line, but once we get to it, we'll need to break it from a rising bottom. Otherwise, stay bearish on gold. Let's take a look at interest rates. TBT was a little bit miffed by this last week because it went down when the Fed was making some fairly pessimistic comments for the future of interest rates, meaning interest rates likely to go higher, and they have done that this week. They have moved up, and now they're probably heading up toward this peak right here where I expect it'll stall. But still, rising interest rates, one of the reasons why the market is a little soft. Rising interest rates are what are helping the US dollar. You can see that long-term upward trend. You run away from the trend, you pull back. You run away, you pull back. You run away, you pull back. It happens over and over again. We're running away right now, so we'll pull back soon, but there's no sign of that yet. And really what you can say here is the bottoms are rising. That means the buyers are in control. It's a bull market for the US dollar. Can't say the same thing about Bitcoin. GBTC represents Bitcoin. Here's the daily chart, and here you can see falling tops. That means the sellers are in control. They've been so for a long time. We are approaching support. If we break down through that floor, I think we're probably headed to $10 on GBTC, because that's this old support zone from way back in 2020. And really all of the air, all of the bubble has been burst on Bitcoin. That means there's not a lot of downside, but I see no sign of upside until we start to build rising bottoms. Until the buyers start to come back with some enthusiasm, you really should stay clear of this. All right, let's take a look at my ratings then. Remain bearish on both time frames for US stocks, Canadian stocks, and gold. Oil neutral on both time frames. US dollar bullish on both time frames, still in a good upward trend. Continue to avoid Bitcoin and other cryptocurrencies, bearish on both time frames. And interest rates, the trend is up, which means bullish, which is not necessarily good for the market, but it is a sign that interest rates continue to be buoyant. All right, let's take a look at the day trade of the week. It was a pretty quiet week for trading, end of the month, and of course long weekend coming in. It was pretty hard to find things that were worth trading, particularly on Friday. And in fact, many of the signals I got just didn't work. This one is one that did work, but I don't want to mislead anyone. It was not a great trading day on Friday. Things didn't go all that well. And when the market isn't doing great, what I'll often do is be much more aggressive on the exit. So we had a buy signal right there on the break of a pullback. This is FRGE, stock that was in play earlier in the week, took a couple days of rest, came back and gave a little intraday pullback play using my action candle indicator. And in situations like this, I'm going to plan just to exit when it gets up to the highs of the day. The market wasn't doing well. It's a quiet day before a long weekend. I don't want to be greedy. So your risk reward lines, your entries here, and then your stop loss point would be right about down here. And then you can measure that distance for your reward. So 1, 2, 3, 4 roughly. I didn't draw that perfectly, but you get the idea. So you've got 4 RR of reward. So if you take $100 of risk, you make $400. If you make a trade that has $1,000 of risk, you make $4,000. When I talk about risk, that's the difference between the entry price and the stop loss price. So if that's 15 cents, then you divide 15 cents into your risk tolerance. So 15 cents into 100, for example, that tells you what your number of shares to be purchased is. These are all concepts that are taught in my different courses that you can get at stockscores.com. Go visit the website. Trader training area will give you information on that. Let's go through the economics of this trade. For every $100 of risk, there was a position of 830 shares. 830 shares times the entry price, which was $377, was $3,130 of capital. You can margin this stock 3 to 1 because it's over $3. So you only actually have to use $1,043 of your own money. The broker will lend you the rest, provided you have a margin account. As I said, the reward at the peak there was 4 RR. That represented a $400 profit for the $1,000 of capital that you had to put up, a 38% return on a one-day hold on a day when the market wasn't all that great. So that's a way to squeeze a little bit of money out of the market. It was also maybe not a bad idea just to go to the golf course or the beach. The summer's over. We're back to the fall trading in September. We'll see how things go. I expect that we'll start to get a little more action as the summer draws to a close. Hope you've enjoyed this week's video. Please click the like button if you have. Leave a comment. And most importantly, trade well.